Are you tired of seeing a big chunk of your hard-earned money go to the IRS every year? Well, what if I told you there's a way to keep your money in your pocket while still growing your wealth? That's right. Private money lending isn't just a great way to earn high returns, but it also offers you some serious tax benefits. In today's video, I'm going to break down the secrets of reducing your tax burden through private money lending. Stick around because this could save you thousands of dollars. We all know taxes are part of life, right? But that doesn't mean we have to pay more than we should. When it comes to investing, taxes can take a significant bite out of your returns, especially if you're earning income that's taxed at higher rates. Here's the thing, private money lending offers a few smart strategies that can help you reduce your taxable liability, so you can keep more of your earnings while still growing your wealth. Let me give you some examples. I work with an investor who was paying way too much in their taxes on their real estate investment. They was frustrated because he making great returns, but the tax bill was eating into the profits. So we ended up looking at how things were structured, their investment to take advantage of the benefits available to private lending. They was able to significantly lower their tax burden and returns skyrocket. That's the kind of difference we're talking about here. So let me break it down in steps. Step one, you gotta leverage the capital gains tax. One of the best tax advantages of private money lending is that your interest income can sometimes be structured to be taxed at the lower capital gains rate rather than the higher ordinary income tax rate. So capital gains tax rates are usually much lower than income tax rates, which means you keep more of what you earn. Let's break this down with an example. If you earn $10,000 in your interest from a private lending deal and it's taxed as ordinary income at say 24%, you'd owe $2,400 in taxes. But if that same $10,000 is taxed as a capital gain, the rate could be as low as 15%, meaning you'd owe just about $1,500. That's a $900 difference just from how your income is categorized. This is especially powerful if you're lending on longer term deals. Many private money lenders structure their deals so that the profits qualify for long-term capital gains treatment, which can provide significant tax savings. That's money that stays in your pocket, not Uncle Sam's. In addition to that, we're going to go into how using the tax-deferred account can help. So another powerful strategy for reducing your tax burden is to lend through tax-deferred accounts and a solo 401k. So a self-directed IRA is what it is, or a self-directed IRA. These accounts allow you to grow your investments tax-free until you withdraw the funds in retirement. So by deferring the taxes on your interest income, you can let your money compound over the years without having to worry about paying taxes each year on the returns. Let's say you're lending through a solo 401k, all the interest income you earn from your private lending deal stays in the account and continues to grow tax-free. You only pay taxes when you withdraw the money in retirement. And by then you might be in a lower tax bracket. This allows you to maximize your returns while minimizing the impact of taxes. It's worth noting that self-directed IRAs also give you the flexibility to invest in private lending deals. Many investors use these accounts to lend money to real estate investors, all while deferring their taxes. This can be a game changer, especially for long-term investors who want to keep growing their wealth without worrying about the annual tax bill. Think about it, that 401k money is still just sitting there. It's not being used. So now you're gonna make it work even harder. You're gonna put it out and lend it out to another investor and make even more money and make it tax-free. I know a couple, who was, I would say, using their self-directed IRA to fund several private lending deals. Over the course of 5 years, they earned tens of thousands of dollars in interest, all tax-deferred. That money stayed in their account, compounding year after year. By the time they retired, they had a much larger nest egg than they initially thought would have. And by paying taxes on their earnings each year, it's a smart way to grow your wealth while putting off taxes until later. Another piece of the story is deduct investment related expenses. It's another, often overlooked benefit, private lending is that many of the costs associated with lending can be tax deductible. This expenses might include legal fees, your due diligence costs, even interest on money you've borrowed to fund your deals. By deducting these expenses, you can reduce your taxable income, further lower your taxable liability. Another example, let's say you're spending $5,000 on legal fees to draft the promissory note and also to review the real estate deal before you lend the money out. That $5,000 could be deducted from your taxable income, which lowers the amount of taxes you owe at the end of the year. Every little bit adds up, and when you're making multiple deals, these deductions can become significant. Now it's important to keep detailed records of all your expenses related to your private lending. Make sure you track legal fees, due diligence costs, any of the other expenses that directly related to your lending of activities. And when I say due diligence costs, it could be possible, keyword possible, if you have to travel to look at the property, to validate things are running smoothly. Talk with your CPA on the specifics of that, because there's a lot of details required to claim the travel, but still possible. When it's time to file your taxes, these deductions can make a noticeable difference in how much you owe. I worked with an investor who regularly loaned money to real estate developers. Every time he funded a deal, he incurred legal fees and other costs that added up to a few $1,000s per deal. By keeping meticulous records and deducting these expenses, he was able to lower his taxable income by thousands of dollars each year. It's one of those small details that can have a big impact on your bottom line. Offset gains with the losses. That's another strategy to reduce your tax burden and to offset gains with losses. If you had any investments that didn't perform well and you took a loss, you can use that loss to offset your gains in other areas like private lending. So this is called tax loss harvesting. It's a great way to minimize the taxes you owe on your profitable investments. For example, if you lost money on the stock market, or let's say stock investment, but earned money from private lending, you can offset the gain with the loss from the stock. This helps reduce your overall taxable income. And while we always hope all our investments are profitable, using losses strategically can actually help reduce the sting of a bad investment. As you can see, private money lending offers more than just high returns. It also provides several ways to reduce your tax burden. By taking advantage of capital gains tax rates, using the tax-deferred accounts like a solo 401k or a self-directed IRA, reducing your investment expenses and offsetting gains with losses, you can keep more of your money while still growing your wealth. If you found this video helpful, make sure you hit the subscribe button and give thumbs up. And don't forget to check out my next video where we'll dive into more advanced strategies for building long-term wealth through real estate. Thanks for watching, and I'll see you next time.